So one thing that we need to understand, yeah. So as I started the recording as well, correct. Okay, so one thing we understood that what is our economic value added? It is nothing but an indication of the economic profit of the company, taking into consideration the capital invested, how much profit the company is able to derive from the capital invested, taking into consideration the weighted average cost of capital or simply the cost of capital. As the formula clearly states here, your economic value added is nothing but your NOPAT, the net operating profit, which is 98,134 in this case, minus your capital that has been invested into the business, which we are assuming as 5,50,000 into the cost of capital, which is an assumption of 10%, right? So this is your EVA. And here we have taken into consideration and talking about the present value of the growth opportunities, as I clearly stated, that the current share price that you see in the market, it does not only depict the current earnings of the company, the actual position of the company, or the present situation of the company. It also encapsulates the future performance of the company or the future earnings of the company. So these things are taken into consideration when a share price is calculated or when you calculate an intrinsic value of the share. And that we also try to understand in a DCF model when we try to discount the future cash flows. So one thing is clear, the share price that you see for a particular stock or a share in the market, it doesn't only encapsulate the current earnings of the company, but also encapsulate the future earning potential of the enterprise. So that we need to understand. Okay. So here, just see on my note, we are taking this discussion of EVA forward. It says that what is the ideal market value of a share, as I stated here? It is the beginning invested capital. That is the amount of capital that an investor has invested into a particular company. Since we're talking about the market value of the share and not talking about the EV, the enterprise value, so here we can assume that there's a beginning equity capital that has been invested into the company for a particular stock or share, plus the current value at no growth, which particularly states that what is the current valuation of the company, the current value of the company, where we are not taking into consideration the future potential or the future expected earnings, plus the present value of the growth opportunities. So that is nothing but the present value of the future earnings, because ultimately that whatever a company or the enterprise, which is a target enterprise, which we have to do the valuation for, we have to take into consideration the present value of the future cash flows, the present value of the future profitability or the earnings, which have to be discounted at an appropriate rate. We have to take into consideration that appropriate growth rate, how much should be the growth rate, all that we have done in the previous sessions for valuations. So taking into consideration that appropriate growth rate and discounting those future earnings, profits, or cash flows by a certain discount rate and calculating the present value of the growth opportunities. But this metric of PVGO can also be calculated by not taking into consideration that enlarged DCF model. Here, you guys need not calculate the DCF model and project the future cash flows and then take into consideration that PVGO figure. No, simply from a current valuation of the company or a current market price of the company, you can judge that how much is the PVGO figure, that is the present value for the growth opportunities, and how much of the earnings can be attributed, the current earnings can be attributed to the current share price. So that we need to understand. Okay. So here we also need to understand one thing. It says, okay, so itna amount or itna like definition is clear to us. Okay, so we won't be going towards the complexities. Firstly, we'll try to understand the intrinsic value for the share. Okay, like intrinsic value is clearer to us. Now, like here is stated that whenever we are investing in a company, we need to understand that the value of a share in the market is not just a depiction of the current value, earnings and growth and return. I told you, it is also because of the future growth opportunities of a company that the company will take, which will help it to earn an ROCE greater than the cost of capital. So ultimately, see what is the objective? The people who are investing into an enterprise, the people who are purchasing the shares of a particular stock, they are taking that risk, and that risk is encapsulated into that cost of capital. And they ultimately want the business to earn a higher return over that cost of capital. If the business is making a ROCE more than the cost of capital, it indicates that the business is profitable. So ultimately your return on equity should be more than the cost of equity. But if we talk about the valuation of the firm in total, which takes into consideration the interest of both the capital providers And the equity holders, the return on capital employed should be more than the cost of equity or the cost of capital, sorry. Yeah. So we know that how to calculate the enterprise value from a previous post. And what about the PVGO? Because we know that how to calculate the enterprise value. It tends to take into consideration the market value of the shares or the market cap, plus you have the debt, plus you have the minority interest. There can be some lease commitments or the R&D commitments which have been capitalized, which have been added to EV and ultimately expensed in the P&L, and subtracting the cash, correct? Because cash is a non-operating asset, correct? So non-operating income we have to subtract from EV because EV takes into consideration the valuation from all the operating assets of the business and cash being a non-operating income, okay? So PVGO, the formula for which says, please remember the formula for the present value of the growth opportunities. It's your enterprise value, the current enterprise value minus your invested capital, how much you have invested into for a particular business, minus the capitalized value of the enterprise of the EV. So how to calculate the capitalized value of the EVA? This in fact is EVA, your economic value added. So for example, if we have calculated an EVA, right, an economic value added, and we believe that this economic value added will sustain for subsequent years, maybe for 5 years, for 10 years. Then we can take this EVA and we can discount this EVA by an appropriate risk or by an appropriate risk measure, which is encapsulated into the discount rate for subsequent years. And that gives us the capitalized value of EVA, which is also called your market value added, MVA. So ultimately, one thing you need to understand that whenever we capitalize an EVA, it is also called your market value added. Your capitalized EVA is same as market value added. So if we believe that a subsequent EVA will sustain for subsequent years, maybe for 4 years, 5 years, then we can simply discount this EVA by a discount rate. So just assume if it is 10%, and we believe that this EVA will sustain for 5 years, then simply as a DCF model, we can discount this EVA for 5 years by the 10% amount. That is, for example, if your EVA is 10,000 and discount rate is 10%, then we can just take 10,000 for 5 years and we can discount this by 1 plus 10% to the power of 1 plus then 1 plus 10% to the power of 2 till 5 years, simply as DCF model. So that is your capitalized value of EVA, which is also called your market value added. So here I've taken one classic example and hypothetical example just to make you understand the calculations. So here the NOPAT, just assume the NOPAT to be 98K. Your invested capital is 5,50,000. The weighted average cost of capital or simply the cost of capital is 10%. But EVA is nothing but your NOPAT minus your, in brackets, your invested capital into your weighted average cost of capital, which gives you an 43K EVA, 43,134 to be precise. Now, if we assume this EVA is to be stable and perpetual, the capitalized value of EVA is nothing but 43,134 EVA divided by your cost of capital. And here you might be assuming that why we have not taken it for 5 years or 10 years, just make a note of this word perpetual. And I told you how to calculate for a perpetual annuity or how to calculate for a perpetual growth rate. The formula is nothing but the cash flow that you have currently divided by simply the cost of capital. In this case, we have the current EVA divided by the cost of capital because it is perpetual. Agar 5 years, 10 years hota, then like we could have extended the formula as a DCF model, correct? By 10%, and here we get it as 4,31,340 as your capitalized value of EVA or simply the market value added. Now, if we assume that the current enterprise value of the company is this much, 70,31,400. So what would be the present value of the growth opportunities? It would be the current EV minus your invested capital minus the capitalized EVA, which gives you around 61,50,060. So here you need not do the expanded version of the DCF model, project the future cash flows and discount it by an appropriate cost of capital. Thereby using this simple equation, you can calculate this present value of growth opportunities. So अब इतना हमको पता है कि your EVA, your current EVA is 70 lakh, but your PVGO figure is 61 lakh. So how much of the current value of the company or the current share price can be attributed to a present value of the growth opportunities. Simply taking the present value of the growth opportunities figure and dividing it by the current EV. So in this case, we get 87%. So we can say if the current share price of the company is 3,500, right? 3.5K. 87% of this 3.5K, that is 3061, is attributable to PVGO. And just remaining 13% is on account of the present earnings. So this particularly encapsulates that whenever or whatever share price or the enterprise value of the company you have, the majority of which is attributed to the potential for the future earnings or the present value for the growth opportunities, which are investors expecting from the company to give. And just a minute number is on account of the current share growth, because obviously the past performance or the current performance, it doesn't indicate the future results. The future results or the expectation of the future results can be encapsulated into the current market price. Okay, so that is one thing we got to know. If further this annualized EV जो हमने निकाला, right? Improvement to justify the share price. If someone asks you, or like if someone or your interviewer or someone as a market investor asks you as an analyst, that what would be the further annualized EV improvement? How much improvement on an annualized basis the EVA should do, right? To justify the current share price. The investor or the person who is asking you, that person is still not happy. He's saying that 87% is attributable to future earnings. Just 13% is attributable to the present earnings. Still, I'm not justified. So just tell me a value of a company if this annualized EVA is sustained, right? If this annualized EVA is sustained, tell me the value of a company. In that case, we can just divide it by 1 plus 10%, which is your discount rate. And again, divided by again the discount rate to justify this share price. So that is a formula that you have to remember. If an annualized EVA improvement has to be there to justify the current share price, your investor is asking you, people in the market is asking you, they are saying that we are not satisfied. 87% is attributable to PVGO, that is a present value for growth opportunities, and just 13% is attributable to your current earnings. Correct? How much annualized EVA should you sustain to justify the current share price? That is a formula that you can use, which is widely used by your investment analysts or equity research analysts as well. So this above analysis can be done for any of the companies taking the actual numbers, but this thing you should know. At least this thing you should know always. Any questions till now? Then we shall move towards the critical part, which is also very easy. Any questions till now? Suraj is asking that why did we divide this 6 wala number by 7? Say Suraj. This much part is clear to you, right? And how to calculate the present value for the growth opportunities. Correct? Itna we know that your current share price is equal to what? A part of the present earnings plus a part of the future opportunities discounted at a certain rate. So if we know the current share price, we know how much is the current earnings, and we want to know how much is the present value for the growth opportunities, we got this number. Now, out of the current valuation of the company, if you take the PVGO in the numerator and divide it by the current valuation of the company, we get 87%. So this shows that out of the current valuation of the company, 87% is out of the present value of the growth opportunities. So if out of 100, if 100 is the valuation of the current of the company, the current valuation of the company is 100, 87 is coming from the present value of the growth opportunity. That is, the future cash flows being discounted at a certain rate. The remaining 13% is the current rate. Correct? So like that is the logic that you need to understand. And in this PVGO, you need not do the enhanced cash flow model. It might give you a similar answer or close to same answer if all the parameters are defined and closely stated. But this is a clear metric and easier way in which you can calculate that how much of the current earnings or how much of the current valuation is attributed to PVGO. Okay. And this is the formula that you have to remember, Aniket. If you have to justify the annualized EVA, further the annualized EVA improvement to justify the share price. That is how much the EVA can be improved on an annualized basis. taking into consideration the current capitalized EVA and the current discount rate. This is the formula that you can use, dividing it by the discount rate simply, and whatever value you get, you can further discount it. A formula closer towards the terminal value calculation in the cash flow statement. Correct? Now, the thing that comes into the question, like any questions till now, I'm more than happy to answer like any more concerns, because I got 15 to 20 similar questions. I just saw the chat box and all the questions have the same answer. Okay. So I try to understand the concept of EVA, the economic value added. We try to understand the market value added, and we also try to understand the capitalized value of the EVA. There's a market value added, and most importantly, the present value for the growth opportunities. Correct, the PVGO. Now, here the question is, and I also stated one more important point. So now our focus shifts towards this point, that is that ROCE should be more than cost of capital, and this should be sustained. Till the point of time the ROCE is greater than cost of capital, the business is making profits, shareholders, investors are happy. Correct? So the question that comes into place is, which we tend to ignore as normal investors, but which the equity researchers or the people who are doing some research upon the company, the professional experts, which they tend to take into consideration, but they might not disclose this number in public because that is for their own understanding, because they have to rejig their portfolios. They have to do the kind of the asset allocations and security selections also based on these numbers. And because for each and every stock or a share, they won't be telling you that which share they have purchased or sold and why. They would just tell you on the basis of some valuation metrics, some growth opportunities, that's it. But this number they won't display. And this number is also important when you are starting your journey into such roles. Now, the question that comes into place, till what time the valuations can sustain, or till what time the company can deliver a return on invested capital greater than the weighted average cost of capital, or simply till how much time that the return can exceed the expectations of the opportunity cost, right? So here we have taken one classic example, and I've shared this post on my LinkedIn as well. So just to make you understand from a deeper perspective. So let us try to understand with an example by taking a hypothetical company A. Now we know that what is the intrinsic value of a company, or what is the market value of the company, which I just explained you in the previous content, right? The value of the company at a steady state, or the current earnings of the company, the current situation of the company, or the current value of the company plus the PVGO, that is the present value of the growth opportunities. Now, the current valuation of the company is not only based upon its present performance, but also the future growth which can accrue to the company. And that we studied in detail in the previous discussion just 5 minutes back. Now, this is an important point. Now, your present value of the growth opportunity depends upon the spread. So what is the spread? Your spread is nothing but the return on invested capital, ROIC, minus the WACC, or simply the discount rate. So basically your PVGO, it depends upon to the point of time your ROCE, ROIC, or simply the ROCE is greater than your cost of capital. The durability of this spread is also important. And what do I mean by durability? By durability, I mean till how much time this ROIC will be greater than the weighted average cost of capital. Because it cannot be for lifetime. If the company is into existence for 5,000 years, for each and every year, it cannot give the ROIC more than WACC. There should be a point of time when the company matures, the company goes into stagnation phase, and the ROIC will collapse. It will come equal to WACC or less than WACC. Then after that time, the company can again deliver that ROC more than WACC. But there should be a point when this ROIC and WACC will collapse, like when they will come together, or this ROIC will fall below WACC, right? Then the company can revamp its operations, the company can do more activities, exceed its cash flows. And after that, again, the ROIC will be more than WACC. But at least till that particular point of time, till how many years this ROIC will be greater than WACC, till the point of time it collapse. Right? So यहाँ पे क्या है? I have just taken some numbers. It means see till how long the company can achieve the ROIC greater than the weighted average cost of capital. Now just assume the company has a return on invested capital, which is same as the return on capital employed. ROC is same as ROIC. Some books some notes or some Google links might give you some different complicated definitions for ROIC versus ROCE. Both are same. ROCE is different from ROE, but ROIC is same as ROCE. Okay. The weighted average cost of capital, or simply the discount rate, is 10%. Your NOPAT is for 4,28,600 rupees. Now, at steady state, the company achieves a valuation of itna. We know how to calculate the valuation of the company. Just discount the NOPAT by the current rate. At a steady state, I'm talking about. Here, I'm not taking into consideration the growth rate. Simple perpetuity wala calculation. So here we get this 4 lakh something, 4,151,568. Now the market, here the market, now the market gives an enterprise value of 13 lakh currently. Assume that the enterprise value of the company is 13 lakh currently. Therefore, 70% is coming out from the present value of the growth opportunities. Dekho, itna number, now this logic is the vice versa. If this is the number for steady state valuation, if this is the number for steady state valuation, and this is the current EV of the company, the difference between 13 lakh and 4 lakh will give you the present value of the growth opportunities. You have the current enterprise value of the company. You have the valuation number that shows the present state. The difference between them is the present value of the growth opportunities. And same formula you can use here. This number divided by the current valuation will tell you how much is attributable towards the present value of the growth opportunities. So in this case, 70% is attributable to the present value of the growth opportunities, and the remaining 30%, this amount is attributable towards the present earnings. Okay. Now, how to calculate till how many years this valuation will sustain? Okay. A big formula. Okay. So here you have this big formula. Till how much time the valuations will sustain. So this we need to understand. Okay. Just give me a second. Just give me a second. We'll start resharing my screen once again. Correct. I'm audible to all, right? I'm audible and visible to everyone. Just a check in the chat box. I'm audible to all, right? Correct. Correct. Okay, till how many years? So this you have a complex formula, but this can be done easily in an Excel. Like maybe in the next session I'll tell you how to use a solver in the Excel. But I've recorded one session upon solver and saved it in your section for modules, right? So your present value for the growth opportunity ka number we know, equated with the ROIC minus your weighted average cost of capital. So this number we have the ROIC, we have the weighted average cost of capital, we have the invested capital, right? Into cap, this cap is nothing but how many years this valuation can sustain, divided by the weighted average cost of capital into, again, 1 plus weighted average cost of capital. So this formula you have to remember always if you want, and you have to calculate this cap here. If you have time, you can calculate by using a pen or a paper. So like using solver and Excel, which will give you values in just a second, your cap comes out to be 7 years, which means it's a possibility that the company might earn this durability spread or give ROIC more than WACC till 7 years. That is, the company will earn the ROIC more than WACC till 7 years. Right? This formula is quite big, but you guys can remember. A certain new learning which people might not tell you usually and might not be a part, I would say, of different curriculums or training sessions as well. Take this formula which tells you till how much time the valuations can sustain. Now, again, this is an assumption. It's a possibility. It can happen in reality. The company might sustain for 10 years or the company might sustain just for 5 years. Right? Something wrong might happen with the company. The company might go into bankruptcy or the kind of litigations. Right? In that case, the people might sell off the stock and the company might not earn this ROC more than back. Or the company might diversify into operations, like into some like very great operations, go towards acquisitions. And the 7 years might change to 10 years. So this number might change every year. If I'm saying 7 years in 2024, it might not be 7 years in 2025. In 2025, it might become 5 years or it might even become 20 years, right? Because we have to track the companies on a daily, annual, monthly basis and see the performance of the enterprise. Okay. Any questions? I'm just waiting for the questions because this topic as such for the present value of the growth opportunities is almost done. Any questions? Yes, Umesh, your market value added MVA is same as the capitalized value of EVA. When you're discounting your when you're discounting your economic value added by a certain discount rate, that gives you your market value added MVA. Okay, it is just the same. Either we can say it as the capitalized value of EVA, or we can simply state it as MVA. Okay, your EVA is nothing but NOPAT minus your invested capital into the weighted average cost of capital. And when you discount that EVA, you get your MVA. Any more questions? And this, yeah, Raghav, you can use it in Excel also. I've uploaded a separate video on solver, how to use the solver in Excel. Because when you do it by using your calculator or using a pen and paper, it might take a lot of time. It might take really a lot of time to calculate these numbers and your answers might be wrong. So solver might give you a correct answer. Okay. If no more questions, then this topic for PVSU is closed as of today. And just make sure you revise this topic for this P